Hey everyone, you're listening to the Active Turnkey podcast, a podcast designed for hands-off, passive real estate rental investors. In the Active Turnkey podcast, you'll hear Tom Olson and Jared Stoutmeister discuss all things turnkey rentals with other turnkey providers, service providers, and rental investors. Our goal is to help you reach your financial freedom and whatever comes after that. Let's go. Welcome back to the Active Turnkey podcast. I'm Jared Stoutmeister, your host, and I have here the Tom Olson, owner of...
I've got my Izzy drink this morning.
Yeah, he's bringing it in. We this is the day after the 4th, so we're 4th of July, so we're up early recording podcasts so we can add value to you guys. But again, this is Tom Olson, owner of Good Success and Olson Group. And today we have an exciting podcast for you. Today we're talking about mistakes rental investors make.
Is that exciting?
I think it is.
Okay.
It should be for people who are looking to invest in rentals.
Okay.
Are you guys excited is the question. Are you pumped?
Yeah, well, I guess we should all be pumped. But I mean, when I think about the mistakes that people make, I always want to cringe a little bit, Jared, because like I know I've made mistakes and I continue to make mistakes. And
well, okay,
I think that's one thing that I don't want people to be afraid to make mistakes, but
Sure.
I would love for you to learn from our mistakes or learn from some of our other investors' mistakes. I just think that you get to financial freedom, you get to whatever you're trying to reach faster by trying to learn from other people's mistakes instead of your own. So we're just going to kind of talk about mistakes that we see. Maybe some of these are mistakes that I've made, or maybe we see this happening, and maybe it's a trend, and we're trying to maybe just help people today with today's podcast of trying to figure out what mistakes do investors make. And how can you avoid them, right?
Absolutely. So that's why it should be exciting, because we're actually trying to give you a warning ahead of time. Sometimes investing is exciting itself. And so you get kind of caught up in the deal making. And sometimes we need to back up a little bit and say, hey, here's a warning for you. Here's a couple things people do.
It's like a roller coaster. So
Sure.
There's a warning, you're going to go up the hill.
Okay. And then all of a sudden...
And then maybe it was a mistake to go on the roller coaster.
The floor drops. That's a different ride. Absolutely. So, Tom, what are some mistakes that rental investors make?
Well, I think the first mistake that most people make is that they overanalyze, right? I mean, so they get into a deal or they start looking at deals, and there's just this constant analyzing on the deal itself, on the market, on whatever. And what I don't want to say is that you shouldn't do that, because actually one of the other mistakes I see people make is not doing enough due diligence. So the due diligence piece is very, very, very important. But I think in order to help somebody not overanalyze, I think they just ought to have like a couple of their key metrics and a couple of the things that you've got to check their boxes. And again, like what I've kind of always said is like the property manager is the most important piece of the whole puzzle. So you have to have that puzzle checked. If you have that puzzle checked, I believe you can go into a deal a lot more, not so fearful, a lot more not having to overanalyze, because even if you do make a little bit of mistake on the front end, you're going to be able to still make it through, because this is a long-term investment. This is not this, and it's funny because like even 10 years ago, people were talking about these same exact things. These are universal. People overanalyze, and 10 years ago, like you could have just thrown a pin and bought almost any property in the United States, and you would have done super, super well on. So the things that you should analyze, I believe, are the property manager, the people backing your investment. I think you ought to look at the market, and then look at the houses as well, and just kind of understand what you're getting into, and know that real estate, although it's not fluid, you can't buy and sell like in a day. You can still sell. So I think that also helps people not overanalyze as much. But that's what I see. Like I see people get way down into the nitty gritty, which is fine. You want to ask those questions. You want to all ask. Create your list of 15 questions that you ask for every single property that you're ever going to buy. Yeah. And as long as you click off those 15 boxes, I think it will help. That's a process, and it's the same type of process we use. Like when we buy a house, like we have this criteria. It's got to hit our numbers. Right. It's got to hit. The house has to feel right. It has to be in the right neighborhood, and it has to be. We have to have the right people to be able to manage it in the back end. As long as we have those boxes checked, We buy every house.
And as a turnkey investor, typically you're buying that property from someone. Somehow there's a relationship somewhere, right? In most cases, somewhere in that process, and so you have to at some point build that trust somewhere. And the other thing is, what I was thinking about this point was, depending on how many properties you want to have. So if you want to build a portfolio, you need to have. I mean, Tom, you've said anywhere from 50 to 100 to really be financially free, completely, and with no issues there. And so along that line, when you think about how many properties you need in order to fill that, sometimes that overanalysis can really hinder you from getting to that place. And then to assume that out of those 100, you're going to have every single one going to be exactly the way you want it every single time across the board, it seems like that would be pretty difficult.
Absolutely. But I mean, think about it. Let's go to like multifamily. So let's just say that you're buying a multifamily deal. I can guarantee you that even though every single unit is in the same location, it's being managed in the exact same place, it's being managed by the same people, and normally like it's similar square footage and similar everything, unit's the same. Does that mean every unit's going to perform the same?
Of course not.
No. So, and I think that's the fear. The fear is that these are not all going to perform the same. And I've seen amazing houses managed by amazing people in amazing neighborhoods, in way better neighborhoods sometimes than other houses, and I've seen those houses not perform over the long haul. As well as another property that isn't such a great house, that may not be managed by a perfect person. So you just, it's all about the renter that you get in there later sometimes that really helps determine the ebb and flow. So, and there is some ebb and flow. You have to go into owning a rental portfolio or owning rentals with that ebb and flow mindset, that there is going to be ups and downs, like we're just going to tackle it. So I think that and to me, I think it's fear. The reason why people overanalyze is they fear. And if you really want to get to the real root of the issue, I believe that there's three main issues, and that number one issue is fear. I think that's the biggest mistake that I see that people make. And it's fear on the front end, it's fear on the back end, it's fear when something goes wrong. And I don't think that we should live our lives, controlled by fear.
I like what you talked about, the ebb and flow. I think a lot of times in my dealings with investors, I see they get it, but then when something comes, I think their expectation is static. It's a straight line. That isn't the ebb and flow. And now in the end, you'd like to have a relationship or have a portfolio where there's an ebb and flow, but it's not mercurial. It's not mountains and valleys. You're talking about little dips here and there, which again should be expected when you're thinking about a 30-year investment, if that's what you're looking to do, or if you're talking about a lifetime for that. So that is interesting, the ebb and flow. I like that.
Well, it's kind of funny because that brings me to my next mistake that I think people make, and that is by making assumptions. So so the second mistake I see people make is they make way too many assumptions, and they think it's either going to be like you said, crazy, or it's going to be completely static and there's never going to be anything to talk about. And that's just not what this game is. If you really want that, then I would just say put your money in a CD, because that's the only place that you really get that. People think that it's in the stock market. The only reason why that they don't understand how up and down the stock market is because they're not watching it every day. And if they are, they're probably living in fear. So, what I mean?
And that's why some guys are now getting into real estate.
They just put their money in the stock market for years and years and years and years, and they just continue to dump money in there. And it's in a way, it's like a savings plan, fine. But what most people don't realize is when you have a lot of money in the stock market, you don't get any of the benefits that you get in real estate. So it's one of the least beneficial places to put your money is in the stock market. And we just blindly keep putting our money in there over and over and over and over and over again. I think it's interesting, even Gary V in the last 2 weeks or so, I heard him say, he's like, there's no such thing as passive income. And I was like, I need to listen to this because I don't really think that that's true. I mean, I was really looking at it. with a scrutiny eye, and I'm thinking to myself, okay, I don't believe that whatsoever. But what he was talking about is all these internet marketers that think that there's real passive income out there in this some kind of internet marketing world where you create one thing one time and you just have this automatic income that comes in for the rest of your life. And there's a bunch of scams and there's a bunch of pyramid things that are going on within that realm. But later he backed it up with, if you want passive income, you need to put your money in the only two places that you've ever seen it. And he was talking about high dividend stocks. So, and that's what I think real estate is. Real estate is a high dividend asset. Mm-hmm. You get rent. Mm-hmm. So, and there's not stocks out there that give you the same type of consistent dividend mm-hmm. that you can get from real estate. Or he said real estate. So I was like, okay, I can agree with this statement, because I don't agree with everything Gary Vee says, but most things when he makes a really bold statement like that, I'm like, I want to make sure I agree with him on this, but I didn't up front, but I realized I did, because he said, if you want passive income, you need to find high dividend stocks, or you need to invest in real estate. And I'm not even sure he's educated on some of the other things you can do, like mm-hmm. lending or notes or some other pieces. But most of those are tied to real estate of some kind. Sure. So there is other passive ways to find income, but you just have to get into the right groups. You have to be with the right people. And you have to know what to expect up front. But sometimes you don't know what to expect because you haven't done it enough. Mm-hmm. So, and I think that kind of goes back to the first one, is that fear. Somebody like me, I've been doing real estate investing for over 20 years. And I bought my first rental when I was 20 years old. And so everybody knows how old I am now. Mm-hmm. So I'm over 40, yes. But yes, so by doing this over and over again and having lots of different things go wrong and having lots of things go right, it's kind of like I said in the last podcast, like the deal after the deal is where all the money's made. So like, just let's get through this. Mm-hmm. And it's kind of like your kids, you train up your kids in the way they should go, and like you really hope at the other end, like the 20 years down the road, your kids are not instantly successful when they're 2, mm-hmm. right? Mm-hmm. I mean, mine are. Maybe yours are, Jared, but mine
are not.
Okay, so mine are not.
They have my genes.
So and I think even as a parent, we make assumptions mm-hmm. that our kids. I taught you this one time. How come you don't get it? Yeah. So we can't do that. So those are the first two things. We got bunch more things to talk about today, but yeah.
Before we go any farther, in case you were wondering about Gary Vee's statement, Tom did put his stamp approval on it.
Yeah.
So you can feel confident moving forward in that particular statement.
Right.
Not the whole, but that part. Okay, cool. So I just want to make sure we threw that in.
You can find passive income in real estate, high dividend stocks, lending.
There it is.
And others.
There you go. Okay, so one thing that I had on my list. So I work with investors, and so just to let you know some of the products we provide. We provide your typical standard turnkey product where it's done for you. So we've done the rehab. We've run the numbers, so the numbers should work. There's a tenant in place. It's managed, and it's a productive property. It's cash flowing. So that's the standard turnkey product. And then we also provide Active Turnkey, the Active Turnkey podcast, do Active Turnkey or the Burr method. So we provide that product where the deal's vetted. And so we help you walk through the process. You buy the house and you do a rehab and the same thing. So one thing that I've seen is that guys like that. They like that process. And instead of maybe learning, at least initially, doing a couple of those deals with somebody who knows what they're doing and kind of getting their processes built out, they do it all on their own. Mm-hmm. They do it all on their own. And not that I always tell people you can do it. Anybody can do it. But there's a lot of things that have to happen and a lot of relationships that need to be created in order to be able to do that. And so that's one thing I see right off the bat is people just doing some of these steps on their own, especially when they don't really have any kind of experience in these fields.
Yeah, I mean, we see this on the other side. Mm-hmm. So by saying like doing it all on your own is a mistake, I think if you don't have to go at it all alone, I think it's a mistake. Mm-hmm. Because there are so many people out there that will help you. Mm-hmm. There are good realtors that will help you. There mm-hmm. are good property managers that will help you. There are good contractors that will help you. If you'll put together a team of your own, I think I do this on my own. So like, I don't want to say that it's always a mistake to do it on your own, but I think it's not the best way. If you're a professional mm-hmm. or if you're a person of means, I think it's not worth your time. Mm-hmm. I mean, so as far as, so I get what you're saying. I totally agree with you. I don't think it's the best way. It's not the fastest way to financial freedom. It's not the fastest way to get to your goals is by doing it all your own. I think that by and sometimes you have to pay a little bit more for the property because, if there's a provider in there, they need to make a little bit of money in order to make deals work for them. But in the long run, like it's like hiring a property manager. Can you manage your properties? Absolutely. If you want to manage your properties, I never fight with you. I've never had somebody go from us managing their properties to like managing them on their own. Like I've never seen that happen. In fact, normally I see the opposite. Yeah. Because they get in these and like, oh my goodness, I can't do this. It's so hard. Well, that's because most of the time they don't have systems or they don't have time or they don't, or it just kind of messes up their normal schedule. So putting that in somebody's hands that does it all the time and has their systems and has automations and has things that are help set up I think is the smarter long-term way to go. Will you make a little bit less money today? Yes, probably more than likely. Because if you manage it yourself, maybe you're going to make a little bit more money. But that extra $100 you might make, is it really worth how many hours you're going to spend?
Right. And time is one of those factors. So one thing I see is professionals is weighing their time, measuring their time, trying to figure that out, what works for them. Some of them, they are totally fine with that, like how you're describing, allowing somebody else to do it for them. They understand where their bread is buttered, they're money makers in their business and what they're doing, and they're totally okay with that. Other times we have people who maybe see that. We've talked about that in the financial freedom plan, where occasionally guys will want to transition at some point into the real estate. At real estate side of things down the road once they become financially free. So there's different avenues, and I totally see where you're coming. It would make sense for me, for someone like Tom, to do it more on his own than a guy who's a dentist or an attorney or a doctor, someone who doesn't have that daily contact in that field.
Yeah, there's two parts of it. One part of it is this: you're really your core genius. Can you really do this? Right. And the other part of it is it really worth my time? Exactly. I mean, Jared, I could mow my own lawn at my house. Most of the people listening could. You guys could mow your own lawns, but how many of you mow your own lawn? And 99 times out of 100, the answer of why I don't mow my own lawn is it's not worth my time. Right. And I think that's what we have to come to grips with is if you do it all on your own, you are paying yourself $10, $20, $30 an hour. Like that's what the difference is. So if you make 20 or 30 or 50 grand a year, maybe it's worth it for you to do it on your own. That's fine from a time perspective. But most of the people that are going to be buying turnkey rental properties aren't making that. They're making 80, 100, 200, 400, $1 million a year. And if that's where you're at, like I just divide that by 2,000 hours. Isn't that right? Or is it 2,000 hours? Yeah, 2,000 hours a year, and you can kind of figure out, like, is it really worth my pay scale? So normally, just a quick rule of thumb, if you make $100,000 a year, your time is at minimum worth $50 an hour. So why would you do tasks that are $25, $10 an hour tasks when somebody else could do those for you?
Yeah, absolutely. And even the property manager, you really think about what they do and how much value you're really getting. And I mean, do you really want to make a phone call? Do you really want to follow up with tenants? Do you really want to go to a property and fix a repair? How much time are you spending doing that? Yeah, really great story for me. A friend of mine had asked me to do something. He asked me to go somewhere, and I told him I was too busy. I didn't have any time. And he said, "Sure you do. You have time. You absolutely have time." I'm like, "No, I really don't. I'm busy." He's like, "Yeah, you do. You have time. You just feel like whatever you're doing is more important." And it was an interesting lesson for me. Like, well, yeah, that's true. Whatever I had going on was more important. So trying to weigh those things, and sometimes maybe we gotta go back to that, go back and figure out it's not wrong for me to do this, but is it the best thing or is it the most important thing for my time? So definitely. So they do it on their own. That's definitely one thing. What else?
As far as mistakes that we see people make, I mean, I think maybe we probably we could have started with this one, but a mistake that I see is people not having a plan. So, like, I do think it is prudent to kind of wait a little bit And I know, one of the biggest mistakes I see is also people not taking action and just not doing it. So I know some of these mistakes that we see people make may sound contradictory to each other, but I think that it's prudent to create that plan. So create your financial freedom plan, and maybe we can I don't think we've done one on financial. Oh, we did a little bit on financial freedom, but we haven't gone too deep into it. But to create your own financial freedom plan, and then create how you're going to do it plan. So how am I going to create financial freedom? How am I going to use this to fulfill my purpose in life? Having that on paper and having that plan up front and keeping it in front of you all the time, I think really helps you stay motivated. Because I could say like lack of motivation, but the reason why they're not motivated is because they're not putting it in front of their face. They're not focusing on it. And, so I think if you have a plan, it kind of starts there. And that's the biggest part of your due diligence. I think the plan dictates a lot of your due diligence.
Absolutely.
So if you create the right plan, which then creates the right due diligence plan, which then creates how do I vet a person and so all these things are up front. And if you can do them one time, and maybe it takes 6, 8, 9, 10 months to buy your first rental, but then after that, it should be an easy process to be able to just get to 20 as fast as you possibly can. So that's what I would say is the next thing is no plan. And I think that kind of goes along with people just being lazy. And I hate to be the person that points it out to everybody, but sometimes me and my wife were even talking about this morning. Sometimes we are just lazy. Sometimes we don't want to get out of bed. Sometimes we don't want to own our own decisions and own our own portfolio, or you know what I mean? Sometimes we want everybody else to do everything for us, and it's just laziness on our part, or it's pride. So I think if you look at every mistake that's made, I think it's made in one of these three realms. It's either fear, it's either based in pride, or it's based in laziness. And if you really want to get to the cusp of it, if you're arguing with somebody, normally it's because of pride. Or it's because of fear. Maybe you're afraid that something's not quite right, and you don't really know, and a confused mind always says no. But at the end of the day, we've got to be purposeful. We've got to have the plan. We've got to create our own due diligence plan. And once you've created those things, the whole rest of this becomes very easy. The hardest part about financial freedom is the first 10 rentals. If you can get through the first 10, it totally starts becoming easier because you see how things work. The hardest part about financial freedom, I think, is the first $10,000 per month. Once you can hit $10,000 per month, you can all of a sudden see $50,000 per month. And I know for some people out there, you're hearing, oh my word, you can actually get $50,000 a month in passive income. Absolutely. But it's harder to get from $0 to $10,000 than it is to get from $10,000 to $50,000 a month.
Sure. That makes sense.
So, I think one of the last mistakes that I'm going to talk about today is just the people don't take action. So it's kind of the lazy part of us. We just don't take action. We don't take action on deals. We don't open our emails. We don't, we don't make a plan, and we're just not taking enough action. And I see that if you're out there taking action and making things happen, are you going to make mistakes? Yes. Right. The last thing that I think people should be afraid of is to make mistakes. We were in a meeting this week where we were I'm not sure that person should bear that responsibility. And what was my response? I'm well, it's not just the responsibility. He'll learn. If he makes a mistake, he's going to learn. And as a leader, I have to be okay with even my followers making mistakes that might cost me money. You know what I mean? Now, does that mean that if they make a mistake, I'm not going to come back and try to correct it, or we're going to talk about it, or we're going to figure out how to avoid that mistake in the future? No, I'm going to do every one of those things. But that goes to the extreme ownership, which is kind of another thing I had written down here, is having an extreme ownership mindset where, I'm not going to get angry or upset, but I'm just going to own every decision that I make. Grant Cardone has an amazing analogy about extreme ownership in his 10X book. And he talks about, he's he's like, there was this guy that lived in an area where his power kept going out. It was just like, everybody in the neighborhood. And so what happened? Everybody in the neighborhood does what? They just sit around and they complain. They whine and they moan, and it's the talk of the whole neighborhood. They just get around and they go to their weekend block party. And what do? Every person, they just complain about the fact that the power keeps getting turned out. And the power company, it's the power company's fault, and poor pitiful me. Except for one person in the neighborhood, what did he do? He went out and bought himself a backup gas power generator. Okay, well, there's extreme ownership. So he went out there, and it cost him some money. It cost him some time. It cost him, getting out of bed early on a Saturday morning, or doing whatever he needed to do to make that happen. He took control over the situation, and he didn't do it pridefully either. He just went out and he said, you know what? This is the situation I'm in, so this is what we need to do. You put that plan together, you implement the plan, you take action, make it happen. And while everybody else was complaining about not having power the next time the power went out, guess what? He had power. And this is the thing, like, this podcast is really only for the top 5% of people in the world, because only probably 10% of people will even ever take action on this, and only 5% of people are ever going to achieve financial freedom. And I hate the fact that that's the truth, because I think that everybody has the tools, everybody has the resources, everybody has the capability, especially if you live in the United States of America, to be able to have financial freedom. But the problem really lies in the fact that most people are just too fearful. Most people think they know it all, or they're too prideful, or they're really just too lazy.
Well, that's really good. And as you were laying all that out and having a plan and letting the plan run it, I thought more or less of what we do. So when we're doing more or less the same thing you're doing, we're just doing on the front end. So when we are looking for houses that are going to be able to fit a criteria that will provide a cash flowing property to you. So we're doing it,
and we make mistakes.
And we make mistakes, totally. But in the end, what we do is we have a plan and we're in specific areas, so we know our market, we know who's doing what, we have people in place that we trust in that role, and then we have these different things that we go by on our plan for each property. So we run the numbers. If they fit the numbers, if everything's, it goes right in the process. It just goes right through. It fits. And so when you talk about that, I think of some of our investors who we've actually been able to help become financially free. And what often happens is they didn't do that. They didn't get lost in the weeds. They didn't overanalyze. They did take action. But they also didn't feel like they had to know every single thing going on about the property. In the end, it was, does it fit these main things that are important to me? Let's do it.
Well, and they still ask questions.
They did.
And they might still ask questions along the way a little bit.
Yep.
I was on the phone. I was on the phone with an investor, just I want to say yesterday, but it was 2 days ago, and he was asking me what I should do in a certain situation, and I gave him my opinion of what I would do. And this same investor has over 20 units with us, and he continually tells me now. Like, he obviously didn't tell me this when he was buying all these properties, but he continually tells me now. He's like, "Man, I should have bought every single property that you sent my way." And I'm like, well, you can say that now, but you didn't know then. When this next thing comes around, maybe but we have properties right now where I believe you're going to be able to say that in 2 to 3 years. Right. I should have bought every single one of those properties that came my way. And can every market in the entire United States boast that? No. But I do believe that we live in a market and in Northwest Indiana where I think that is still true to the case and the case today.
Well, that brings up another point. I mean, for a lot of people, I do hear that where some people, so talking about mistakes, I've had several investors who want to get in the game, but they say, I missed the boat. It's too late. Interest rates have gone up a full percentage point over the last year or the last 2 years, whatever it was, which they've actually settled back down again, which is ironic. But the whole point is they've said that they've missed the boat, all the while failing to realize that these are still really good opportunities today. And the longer you wait, the more it's going to affect your plan. I mean, and
in 20 years from now, none of that's going to matter.
Right. Exactly.
And if this is really a 20-year game, then why are we thinking in all those little things? What's happening in today's market right now? So I just want to make sure people understand, the extreme wealthy are buying real estate. The institutions So if you look at the total snapshot for the United States, and maybe this is a different podcast, I don't know, but if you look at the total snapshot, there is about $6 trillion in multifamily assets, and there's about $6 trillion in single-family assets. And right now, the hedge funds, the single-family office, the institutions own about half of the multifamily space. They just own it. They own 50% of all of the multifamilies. In the single family space, they own less than one. They own like 500 billion. They own half of a trillion of single family, but they're buying single family like it's no tomorrow. When Warren Buffett gets up and says, like, if I could, I would, and then after that proceeds to say, buy every single family real estate piece in the country that I could possibly buy, like, things happen. And even Warren Buffett has started in that direction, like with Berkshire Hathaway and the getting into real estate and getting into managing brokers. They're buying real estate already. Zillow is buying real estate. This is not going to stop. And I think that if people are going to think that we're at some kind of point in time where this bubble is about to pop and that everybody's getting in, single family real estate is not where the bubble's at right now. And it might be in some extreme areas of the country. So we may have some bubbles being created in some areas of the country, but just because our properties have been going up for 10 years, that's normal. And I think that since we had this unnatural correction in 2008, everybody keeps saying we're in this bubble. But this is the problem, Jared. I've been hearing this since 2015. Yeah. So since 2015, I have been hearing in the next 7 months, in the next 8 months, in the next 9 months, in the next 18 months, I've been hearing this. So everybody who stopped buying in 2015 has now lost every potential opportunity that they could have had.
Absolutely.
And we've seen our area, for instance, in Northwest Indiana, like, that was the best time to buy because houses have like gone up 50% since 2015. We didn't have this quick correction like a lot of other places because we don't really have a quick anything. Like even in 2008, where the average home price in Lake County was like 168, and within 2 years maybe it went to 159 or something. Like there isn't this massive exodus. This is kind of why I like those markets for me that aren't going to be so ridiculously volatile. And I think you can make money in volatile markets if you know what you're doing. But I think that today's opportunities, I believe, are in the Midwest and in the Southeast where it's not super volatile. And that's where if it was me and I'm putting my money in someplace, that's where I'm putting my money in.
No, that's really good. And so now that's my whole point. A lot of the investors were talking about backing out. And they've lost so many opportunities, and really there isn't much difference between now. And I think part of it goes back to maybe pride again. They feel like because somebody else got the better deal, they don't really like that. They don't like that today. They're paying a little bit more today than they did a couple years ago, when it really doesn't matter. So really interesting.
But what's funny to me though is they're not. I went back and looked at some of our performers from 3 or 4 years ago, Jared. There's not much different. Like, yes, we are buying or selling in Gary, Indiana, so that's way lower, way cheaper. So we're selling properties for $55,000-$60,000 now that rent for $850,000, $950,000. Those properties we weren't even selling because I, with good conscience, couldn't sell those properties 3 years ago because it would take 3 months for them to rent. Now, like, we just rented a house in one day for $950,000 in Gary. So it's like, markets change, and you have to be willing and able to take those changes and understand what's going on. But our typical B class, neighborhood, we were selling 3-4 years ago for 105 to 120. What are we selling now? 105 to 120. Like, there's not this big. I think that there's this perception out there that's not even true. We know what the numbers are that investors need to get. And turnkey providers should know that. Now, I think some turnkey providers have squeezed some of those numbers a little bit. And for us, I think numbers may not look as good as they did on our performas than they did 3 or 4 years ago, but it's because we've gotten smarter. Mm-hmm. It's because we've tried to put more due diligence into the performa ourselves. It's because we've put more money on their performance for things like vacancy. We put more money in our performance for things like maintenance, and to me, like, I don't even think that you have to put those on your performance. I know guys that sell hundreds of turnkeys a year. They don't put any of that on their performance, and they say things like, the rent increase over the years will pay for all that, and I actually believe that that's true. But for us, we've learned, okay, there is going to be some vacancy, right. There is going to be some maintenance, so let's just put it in there, so that way, like, we can do as much as we possibly can for somebody up front. But I think at the end of the day, they're still making about the same amount of money, and I still think that they have the same potential for appreciation, maybe more so now, because we're really starting to see real estate move in an upward direction in those houses that are worth under $150,000. Like, we really are. Had a guy that sold a house for $189,000 that he bought from us for, like, I think he was all in. He was an active turnkey, and he was all in like $120,000, and he held on to it for 4 years or so. And but he even had to struggle with that. Should I take $60,000 in profit right now, or should I just hold on to it?
Right.
You know what I mean? Like, I talked to a billionaire that bought 1,000 units in Europe in the 50s, and he's like, why would I ever sell these? So it all depends on where you're at and how you want financial freedom, but I think that real estate is one of the best. I want to say kept secrets, but the problem is it's not a secret. I think it's just hard work, and people got to get out there, build relationships. You have to have relationships in this business.
Absolutely.
And you have to have trusted relationships. You have to make sure that people are going to do what they say they're going to do. You have to be careful not to be so prideful to think that, like, everything is going to be perfect and everything is going to go your way, because it's not. And sometimes we just have to, have conversations and just communicate and just make things happen. So those are the biggest mistakes I see. Do you have anything else, Jared?
No, I think two things. You mentioned the relationships, and I think one thing that even recently we've had where there's the idea that it's a relationship, but it's since we're providing that service, I think in the end we are so motivated and compensated by our relationship with our investors. It makes so much more sense for us to provide a productive product to our investors. So, of course, we're highly motivated to provide that. And sometimes there can be, one of our future podcasts we'll be talking about is what as the investor, what should the turnkey provider expect from the investor? Kind of the other side of the coin. So it is a team game. It's us working together, and so we've had experiences recently with a couple investors where there was a little bit more adversarial over a situation, which was like, this is so common. This is something we need to work through to build. This is how real estate works, right? And so the relationship piece is really good. And then, like you said before, about people who maybe waited, they're waiting for 2000, whatever the next bubble is, so they can cash in. Meanwhile, they're missing just how many opportunities, and they're waiting for something that we just don't know. We just don't know when that happens. Like you said, if it's in one of those volatile areas, I think we'd be a little bit more realistic there. But if you're looking to invest, watch out for some of those naysayers who are saying, "Hey, this is going to happen," because like you said, they've been saying.
Well, the other thing, so if there's one more mistake that I see investors making right now, especially, and these are investors that are working with turnkey providers, because this is not just us that I know deals with this. This is other people having the wrong upfront expectations.
Sure.
I think is a huge mistake. I think it's seated in pride. With like kind of where I went to, but just something as simple as just signing your property management agreement. Like, if you don't sign your property management agreement, I need you to understand, like, you have no rights. You have no right to complain. You have no right to say that anybody did anything wrong, because you don't even have an agreement. Right. We send property management agreements to people sometimes, and we don't get them back signed for 3, 4, or 5, 6 months. We, out of the goodness of our heart, because we sold them the property or because we're connected to them, try to still do what we can, but there's limitations in what we can do unless we have the property management agreement signed. It's like, to me, I don't understand. Like, to me, it's the number one most important thing you have to do with your property manager every single time. Right. Sign your property management agreement. I'm sorry, like, and there's a situation that just came up, but this isn't the first time this has happened. This has happened multiple times where, so make sure that you have the right upfront expectation. And maybe, like you said, maybe we should do a whole podcast just based on, like, what are the expectations from the investor when they're dealing with a turnkey provider? Because I could probably go on and on for a whole entire month about that. But I think some of that is the upfront expectation. And a lot of the upfront expectation is, so the other thing I see is people not reading their property management agreements. Like, read the property management agreement. Everything that we're going to do and what we're allowed to do, or what anybody's allowed to do, is in that property management agreement. So one of those things is, like, how much money can they spend without your approval? And what are they going to do? And if so for us, I think it's around $400. So basically, if there's a repair and it's under $400, we're not even going to tell you. We're just going to do it. We're at the end of the month, we're going to tell you we did it, and we're going to bill you for it or take it out of the rent. But, like, if there's a larger repair that needs to happen and you don't respond to that email or text or phone call, and it takes 2 months, 2 weeks, or whatever, like, you could do some serious damage to your house if you're not. Now, if we have the property management agreement signed and it's an emergency, we can still obviously go make sure that we take care of the property. But in situations where it's just turnover or something like that, where we just need an approval, we're now prolonging that time period in which we're going to be able to get that house rented if we don't get somebody to respond to us. So respond to the property managers' requests when they're asking things, and sign those property management agreements. Have the right upfront expectation and read the property management agreement, because I think that will really help you understand what that expectation is.
Yeah, just real quickly to tag on that, I think, again, it's a relationship. So when Tom's talking about your plan, you put it together and you're doing your due diligence on a market, and then you go and start creating relationships. The whole idea, you're creating a relationship with somebody that you believe when something happens, they're going to do this. And so you've created now this relationship and this idea of trust. Now, the idea would be, if something were to come up, you would expect that person to handle it, right? Because that's what you're bringing them in for. However, in the term of a relationship, that's reciprocal. So in the same type of concept, you're saying, so as the property manager or what have you, they need that from you as much as you need that from them. It's a team concept. And so it's not necessarily the property manager working for you solely. It's a back and forth. And that's the whole relationship. It's how any relationship is measured, is by each person doing what they're supposed to do and what's expected. So I think that's really good stuff. And so all kinds of information. There's so much more we can go into, and we probably will at some point in a different podcast. But
so this was exciting, right, Jared? Going over all the mistakes.
Can you guys feel it? Can you feel me? It's just crazy,
Thank you so much for listening today. I really appreciate everybody's support of the Olson Group Network and of this Active Turnkey podcast.
Yeah. Remember, we do provide rental. We do help investors build rental portfolios. So if you're looking to invest in real estate, we'd be happy to help you and try to build that. And so again, if you're looking to do that, you can reach out to me. You can reach me at Jared at Buy Olson Group, or you can go to buyolsongroup.com. And thank you for listening to the Active Turnkey podcast.
The best way to buy rentals.
Thanks, guys. Olson Group Network makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Unless specifically stated otherwise, Olson Group Network does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. Any third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of Olson Group Network. Olson Group Network assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials or on third-party sites referenced in this podcast, or the compliance with the applicable laws of such materials and/or links referenced herein.